Good morning, everyone. Good morning, everyone. It is July 28th, 2025. It is so good to see you all this beautiful and amazing Monday morning here in Austin, Texas. Let's go ahead and do a sound check. Let's go ahead and just get some thumbs up. Want to make sure that you can hear me okay for this Monday morning touch point. You can write it down over chat. Give me a thumbs up or just say, I can hear you okay. Hopefully you can hear me, because if you can't hear me, then okay, good. John D, I hear you. Good stuff. And if someone can unmute themselves and say testing, 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 I want to make sure that I can hear you. Kevin, go for it.
Testing, testing, testing.
Oh,
Happy Monday.
I love it. I can hear you loud and clear, Kevin. So good to hear you. You all, we've got a lot to go over this morning. It is our Monday morning touch point. This is where we go over the single best leading market indicator available for the entire area, the new listing to pending ratio. We simply, very simple, but the most effective things tend to be the simple things. That is where we take all the new listings, the back on the market, and we simply divide it by the properties that are active, under contract, and pending. And that's going to give us a ratio that can either be a 1-to-1 ratio, meaning 100 properties come on the market, 100 properties get absorbed by the market. And if the ratio is over 1, let's just say 1.2, that means that 120 properties get absorbed, even though 100 came on the market. If the ratio is less than 1, that means that less properties are being absorbed by the market. So we start off this meeting by updating that new listing to pending ratio. And then we do a complete market overview on what inventory is like, what activity is like. And then we look at the economic factors affecting the market and rates, the bond market. Let's go ahead and really hit it hard. We're going to start by updating the previous 7 days on the new listing to pending ratio, the number of new listings. Keep in mind, this is for the 6-county area: Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett counties. Number of new listings. Wow, this is really interesting. Yeah, as a matter of fact, this is so interesting that I'm going to run the numbers again just to make sure that it's accurate, because it seems really low. 971. 971 new listings. A dramatic drop. Now, we're going to get about 100 or so listings between now and 11:59 where this number gets locked in, but 971 is a low number. Last week, we had 1,221. Does this signal that sellers are like, oh, done, it's going to wait till next year, wait till the spring, it's over? That could very well be the case. That is a very low number to start off the day. Let's go ahead and just do price increase. Okay, interesting. 148 price increase. That's going to be the largest number we've had going back 4 weeks. Let's go to price drop. That's a high number, 2272. That's going to be 94%. We got up to 96%, which is a 25-year record high. When we got up to 96%, we had never seen a 96% ever. That was a 25-year record high, 96%. Now, that's simply a price movement, meaning out of everything that could have gone up or down, what percentage of that went down? That doesn't mean that 96% of the properties went down in price. That's like 58%. That means that out of everything that could have gone up or down, what percentage went down? That's going to be 94% right now. So that's going to be better than last week, better than 2 weeks ago. What about back on the market? What's going on with back on the market? We're at 188. That's a lower number back on the market. Let's go to active under contract. Oh, okay, not bad. 426. Less than the previous week. The previous week, we just had a very high number on active under contract on the previous week. Really, really high number. That's just really amazing. That was, look at that. 426 active under contract. 426. Really interesting. Now, let's take a look at pending. This is where you get to guess. This is where you get to guess how many pendings. We're going to go ahead and just get 5 guesses going. Let's go ahead and just do 5 guesses. Number of pending last week, we were at 413. Of course, we know that's not where we start. We always start a little bit lower. Violet is going to start us off at 222. We've got 1 down, 4 to go. We've got 235. Harold coming in a little bit more on the bullish side of things at 235. 2 down, 3 to go. We've got Seth at a very bullish 269. Melanie coming in at a bearish 185. And we've got 1 guess left. 1 person. Go ahead and just type your number. I will read it out loud and then I'll click on the little checkbox. We've got Drew coming in at 250. John D at 199. And the number comes in at 249. 249. We are starting off at a 0.58, mainly because the number of new listings is so low. Now imagine if we were at 1,200 new listings, we'd be at 0.49. So the fact that we are at 971 new listings entering the market, that is a very surprising number. We will end over 1,000. We're going to end probably at 1,070 or so. Probably at 1,070. All the previous weeks are updated. I went ahead and updated all the previous weeks, but let me go ahead and just make sure. So yeah, this one right here goes to 417. Let me go from the 7th to the 14th. That's going to be 450. I did update it really early this morning, but there were a few other properties or a few more properties that agents are updating. Let's go from the 23rd to the 30th. That's 524. Everything else is updated. So thank you, Violet, for the reminder. So this is all completely updated. So here's the good news. Good news is that we did go up from a 0.61 to a 0.64. We're at 0.58 right now. That means that we are going to beat that 0.64. We're going to come in right around the point. We're not going to quite reach 0.7. There's no way we're going to reach 0.7. We will be between 0.65, 0.68. That's where we're going to be when this is all said and done. Let's do a little bit of a comparison here. So even though the number of new listings dropped quite a bit week over week, look at the year over year. The year over year, last week, we were up 18.8% year over year. Already we're up 3.5%. So here we've got a really big drop in the number of new listings entering the market. But when we look at it historically, the same exact thing happens last year. We went from 1,028, drops down to 938. So right now we're already at 971. Look at the new listing to pending ratio last year. This time last year, 0.90. That's because, so now we know the trend that the last week of July, number of new listings entering the market drops. Now, in comparison, this year compared to last year, we have more new listings entering the market compared to last year, even though week over week, it's gone down by quite a bit. We're already at 3.5. This number is going to go up by about another 100 or so, 75 to 100. That's what we notice. And so we're going to have 130 more new listings entering the market the same week year over year. We have 3 more price increases. We have 198 more price drops. We've got 50 less back on the market. And so far, we have 381 less pendings. This number is going to shrink in. It's going to be triple digit, close to triple digit, but we have been negative on the pending side of things, active under contract and pending, going all the way back to March. And look at the ratio, 0.58. Right now we got a 0.58. Last year, a 0.90. Let's go ahead and just update the monthly. First thing we're going to do is update the month of June to see if we have to increase this. That does not change. We have so far today, we have 6-county area, 15,833 active listings currently in the market. Let's take a look at how many new listings so far. We have 3,884. How many price increases? 587. How many price decreases? 7,707. 93%. We've got 3 months in a row at 93%. But last July, we're at 94%. So far, we are outperforming last July on the percentage of price drops. Let's take a look at back on the market. How many back on the market? We are currently at 824 back on the market. That number goes up a little bit, 21%. Active under contract, 1,788. Pending so far this month. This is going to give us the entire new listing to pending ratio for the entire month. Wow. 1,257. We're at a 0.65. Last year, 0.77. At a 0.65 right now, we're not going to get up to 0.70. I'd say we're going to be around the 0.68 when this is all said and done. A lot of agents don't update the pending until the month is over. So it's going to be somewhere around that 0.69. That's what's going to happen. Let's go ahead and just do the withdrawn. And withdrawn is going to be 1,033. Very high number on withdrawn. Expired 334. And now I've got to go to a separate search to get the sold. Let me go ahead and just pull up the sold information so far this month. And we are looking at 1816. Let's update the previous month, make sure everything is perfect. And that's going to be 2935. There we go. Everything's perfect on that. Take a look at the withdrawn and expired. 1,033. As a matter of fact, let me show you what's going on with withdrawn and expired. With it being the 28th at 1,083 already, this number is going to go up to almost 1,300. So our forecast is 1,239 on the withdrawn, just on the withdrawn. Do you notice where that falls going back 10 years? Record high. We usually don't see a record high. Statistically, record high withdrawns are meant for October, November. Record high expireds are meant for December. But we are now seeing record high withdrawns in the middle of the year, July. We just reached a 10-year record high on the number of withdrawn properties in July. At the same time, look what's happening with leasing. What do you think's happening with leasing inventory? Let me pull this up. Record high. So we've got 7,310 active residential lease properties available in the MLS. That is a massive number. That is up 162.8% in 5 years. That's up 149% in 10 years. So we've got record high leasing inventory, record high withdrawn inventory. Do you think there's a correlation there? What do you think? Absolutely there is. It's the accidental landlord effect that we're reading about on national headlines. Everyone's talking about the accidental landlord. It's like, oh, not selling. Let's go ahead and lease it. But with a record high leasing inventory, we're going to notice more pressure on leasing pricing. That's already happening. That's going to continue to happen. So keep that in mind. Let's keep on looking at some of this information. What I'm going to do right now is do that market overview because we do have some charts that goes over the new listing to pending ratio. But let's take a look at complete inventory. We are at right now 17,910 active listings currently in the market. We are 166 listings from the previous peak, which was June 27th at 18,076. I don't think we're going to reach that number. As of now, and you take a look at this right here, we are going up, but we always go back down a little bit. I don't think we're going to reach that number. Now, out of all of the active listings currently in the market, here's the breakdown. We do have 52 short sales holding steady at 52. And then I'll go over the activity index on resale. Out of all the active listings currently in the market, 58.9% of those have experienced a price decrease. 58.9%, really amazing. And you can see that we are up 15.7% year over year on the number of active listings. This time last year, we had 15,486. In the cumulative number of new listings that have entered the market, we're 26% above average. We have 33,392 new listings enter the market so far this year from January all the way to today. That is a 5.8% increase year over year, taking a look at exactly the same time frame. When you look at the number of pending listings, this is really encouraging because when you look at last year, we just kept on going down. So last year, from the end of June all the way to the beginning of September, it was just down, down, down. Little bit of an increase there, but just kept on going down. You see that down step? This year is a different story. This year, beginning of the transitioning from June to July, we bottomed out because a lot of pendings close. But since then, we are going up. We are now almost crossing last year's pendings. That's really encouraging. The fact that we are getting more pendings compared to last year from the beginning of July. So the entire month of July, the number of pending properties last year, down, 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 down. This year, from the beginning of July, pendings are going up. We're still down 0.5%, but if the trajectory continues, we're going to be now positive on the pending compared to last year. And that's really encouraging. That's something that we did not see. We have to go all the way back. It happened a little bit right here in May, just a tad right here, end of April. But pendings are supposed to be going down. And then in September, pendings go up a little bit, really erratic. But right now, we're noticing a little bit of a bump on pendings. Very unexpected, very, very encouraging. But we still have way more active properties on the market compared to last year. So when you take a look at the activity index, pending divided by active plus pending, we are still lagging compared to last year. We've got, could this be an indication that we're close to the bottom? Well, we certainly have seen a dramatic improvement on the median income to sold ratio. And that's going to be my go-to. It's going to be the median sold to income ratio. It's all about affordability. It's all about what people can afford. And when you see this one graph, this is a combination. This is the percentage of income going towards a mortgage payment. And let's take a look at this one also. More so this one, the median sold price to income ratio. We are currently at 4.09. The average is 3.72. We got up to 5.75. I told you back in 2022 that this line was going to regress back to the mean, right? I'm a mean regression theorist. And it has indeed done that. We got really, really close towards the transition into 2025. I'm a firm believer that we are going to cross this line. What does that mean? Another 5%. That's what it means. Now, real estate markets do have a tendency to overcorrect. That's why in 2022, it got down to 3.08. It went under that average. If the real estate market does overcorrect, which is something that is very common in real estate, people get really scared, really skittish, and now they keep on wanting the bottom, but then, oh, the bottom happened. Well, I don't care. I'm going to wait anyway. And then the market tends to go towards the overcorrection. Then we're talking about 10 to 15% further drop and erosion in price. That's definitely within the realm of possibility. As a matter of fact, I don't see an environment where that does not happen. But even if that were to happen, well, then we were 70% there. We've already gone through a huge portion of the correction. I do not foresee, and you can get your fill on whatever information you want to consume from X. I follow people that are saying 20%, it's going to correct another 20, 30%. Nah, I don't see that. I also see people saying, well, I can't believe it corrected 20%. The market's really cheap right now. It's really affordable and prices are just insanely low and it's going to go up by 15% next year. Well, now that's ridiculous. I certainly don't foresee that at all. We've got an interesting article regarding percentage of income towards monthly housing expense. I'm going to have to read that. Is 30% rule impossible in 2025? 47 of the 50 largest U.S. metros now require more. Let me go ahead and just put this article right here. I'll definitely take a look at this article. Thank you so much, Violet, for sharing this article. Super, super appreciate it. And yeah, I'll take a look at it. As a matter of fact, we'll either go over this on the Friday meeting, but I will definitely take a look at this article. Thank you so much for sharing. Super, super appreciated. Do they have, let's see if they have Austin here. Okay, they have Austin. They're saying share of income 41%. Yeah, city of Austin, no doubt. This is the May median list price. Yeah, 41%. Isn't that crazy? That is crazy. 41%. And of course, we have all this information on affordability. We break down exactly how much is needed based on the percentile analysis. I mean, we've got so much information right here. We've got two cities that are now considered affordable. We've got Jarrow at 31.2% and Manchaca at 30.8%. And on zip code, we've got 3 zip codes that are now considered affordable. We've got 78725, the most affordable one, at 33.3%. We've got Manchac at 33.6%. And then we've got Jarrow, once again, at 33.3%. That's going to be the second most affordable zip code. So take a look at affordability, teamprice.com, insight and statistics, affordability, and you're going to have all the information there that you need. Let's go back to this one. The cumulative pending, when you look at everything that's gone pending from January all the way to July, we're down 6.6%, $26,115, or not dollars, but properties, 26,115 properties, and that's a drop of 6.6%. That means that the activity index is lower compared to last year simply because of the number of active listings currently on the market. You can see that the activity index, very encouraging, is trending upwards. Didn't happen last year, didn't happen 2 years ago. Right now, we've got a little bit of a momentum with that activity index trending upwards. One thing is important. When you break down what is going under contract, what kind of product is primarily going under contract? New construction. That is why the activity index for new construction is so much higher than the activity index for resale. On the resale side of things, we're at a very cold 16.71% activity index. That is chilly territory. On the new construction side of things, we're at 28.39%. Not bad. So when you see the activity index so much healthier on new construction, we have to put that in perspective. Builders are pushing inventory. They're offering incentives. So we have to know that so that we can help our clients get the best deal that they can possibly get. Buda continues to lead the pack on the activity index at 32.1%. And you've got Smithville, 8.8%. We are currently at a 0.64 ratio. Isn't that hard to believe? That's like COVID level ratio, right? This is COVID level ratio. I mean, this is 2008, 2009, 2010 ratio. That's what this is. This is .com. This is great financial crisis. This is COVID. And yet we've gotten used to it. It's like, okay, well, 0.64, it's not that bad. Last month it was 0.59. It's amazing how we get used to this stuff. And here we've got the 0.64 ratio. It is going to be the lowest ratio going all the way back to 2022. And then we have to go all the way back to 2008, even 2010, or actually 2010 at a 0.55 ratio. So that was Terrible, absolutely terrible. But we're at a 0.64 right now. When you add the cumulative difference between new listings and pending, we are plus 7,277. Plus 7,277. That's going to be the largest number going all the way back to 2004. That's the cumulative difference when you take all the new listings, subtract all the pending. What's left? What's that buildup in inventory? Highest going all the way back to 2004. So for the new agents that are like, wow, this is a lot of new information. Like, hey, here's the thing. This is a market. Unless you've been in business for 21 years, which I got in business in 2004. Unless you've been in business for 21 years, no one has ever experienced this market. This is new for everyone. So whether you've been licensed for 5 years, 7 years, 1 day, 3 days, 2 hours, you are learning a whole new way of selling real estate in Austin because no one has experienced these numbers before. This is truly unprecedented. It has not happened in 21 years. The level of inventory, the bifurcated nature of the market, a 20% median price drop. This hasn't happened since 1987 to 89. We have to be in real estate for 50 years to experience this level of price correction. So be encouraged. Be encouraged. It's like, hey, this is new. This is new for everyone. So there you have it. Let's go ahead and take a look at a few more things right here. The ratio so far, the entire year, we're at 0.67. The ratio for the entire year is at a 0.67. And there you can see the chart, 0.67. Months of inventory, we are up on months of inventory, 16.3%. Last year, we were at a 5.51 months of inventory. And this is this day last year, exact same day last year. I track this information based on the day, Monday through Friday. When you look at the cities, most inventory, we've got Dale, Lago Vista, Smithville, Spicewood, all over 11 months of inventory. And then you go all the way down, Buda at a 3.35 months of inventory, really tight inventory. And you can see that the city of Austin is only up 7.9% year over year on months of inventory. Year to date, we're up 29.1%. Hutto year to date is down 29.6%. Wimberley year over year is actually down 17.2%. We are forecasting that 2,778 properties will sell this month based on what has currently sold. And that's going to be a 4.4% year over year price drop. We are 8% above average. When we adjust it for population, we are 6.7% year over year drop and a 20.2% below average adjusted for population. When you adjust it for realtors, and you heard me say this last week, 3 years of exactly the same. The number of sold properties adjusted for realtors, 3 years exactly the same. Right around 946, 967, 964, right around 950. 950 properties sold per 1,000 realtors for 7 months. Amazing. Now let's talk about pricing. Because pricing is going down. On the median sold price, this morning, when you look at everything that's sold so far this month, we are now negative month over month. We are down 1,227. We're at 443,763. We are down 1,237 year over year. On the average, we are up. We're up both month over month and year over year. I do expect that we go negative on the month over month. We will remain positive on the year over year. But one thing that I noticed that's really interesting is this right here. A 97.13 sold to list price ratio. So let's take a look at that number. 97.13. That number's going down. When you look at July, that's going to be the lowest sold to list price ratio going all the way back to 2011. So sellers are getting less than what they have gotten going all the way back to 2011 for any July. That number is shrinking, meaning the sold to list price ratio is getting way smaller. Isn't it amazing that we got to the point where it was 109.5? That was April of 2021. Well, right now we're looking at 97.1. And there's the July compared to every July going back 25 years. That number has been going down, and that's going to be the lowest number going all the way back to 2011. Another interesting one is going to be the sold over list. We're at 12.1. 12.1% of sold properties sold over list. That's also going to be the lowest number going all the way back to 2011. So we are experiencing pressure on pricing that's being expressed by the median sold price month over month, the median sold price year over year, also the sold to list price ratio. What's the sold to list over original? Let's take a look at the sold to list over original. That is right here. Sold to list over original, 93.18. 93.18. Last month it was 93.68. June was 94.66. June of last year was 94.66. Right now it's 93.88. So the difference, the gap between the two, 3.9. 2 years ago it was 3.6. Then it was down to 2.8. Now it went all the way up to 3.9. Now, so what does that tell us? Very good question, Violet. More price drops leading up to the property going under contract. And then after it goes under contract, more negotiation power. That's what this is telling us. So very important for us to know this when we are representing sellers and, of course, when we are representing buyers. There's the average sold price at $585,221. We are down $97,000 from the peak. The median sold price now under $444,000. We're at $443,763. And that's going to put us at $106,000 below peak at 19.32. A little bit better than last Monday. We were right at 20% at $110,000. Right now we're at $106,000. But we've had 1, 2, 3, 4, 5, 6, 7 year over year drops when you look at the median sold price. When you compare the median sold price, July 2025 compared to 36 months prior, we are down 13.83. And if today is the absolute bottom of the market and everything else is up, so this is to your point, John D. Well, does it mean that we're in the bottom of the market? Let's just say we are. Let's just say that we're the absolute bottom of the market. That means that it will take 56 months using the 25-year compound appreciation for us to return back to peak value at 550. That's February 2030. The average sold price for the entire year is on the plus side. We're plus $4,796. We're plus 0.8% on the average. On the median, we're down almost $5,000, 1.1%. And why is that? Well, it's because of that famous word that we keep on saying, which is the bifurcated nature of the Austin market, where the top 25th percentile is doing way better than the bottom 25th percentile. So it props up the average price, and that's why the median price is negative and the average price is positive because of the top 25th percentile. And when you look at the 30 cities that we track, 12 cities are up in value, 18 cities are down in value. Jarrell is now down in value by 0.5% year over year, going from $280,000 to $278,000. City of Austin is up, went up from $572,500 to $578,750. But this is where you can see the entire list. This is called the absorption rate. Very simple metric. We simply take everything that is active on the market, everything that is sold. It's just the sold divided by the active. It's just the absorption rate. Sold divided by the active. We're at 11.3%. Now, more properties are going to sell between now and the end of the month. So this number is going to go up. I only start updating the monthly number about a week before the month changes over so we can get some leading insight into what that number is going to be. But I can tell you right now, the number is going to be low. It's going to be under 17.9%. It's going to be right around the 15 to 16%. That's the absorption rate. And this last chart that we have, this is the if you were to score the market between 1 to 10 or 0 to 10, 0 meaning ain't nothing going on, and 10 meaning this is the hottest it's ever going to be. It can't possibly get any hotter. This number is going to improve, but it's going to settle around the 3.5 to 4 right now. And it's already the 28th. I mean, we've got what, Tuesday, Wednesday, Thursday, really Tuesday, Wednesday, Thursday. Friday is already the 1st. So there's a lot of data already going into calculating this number, but it will improve. We're at 1.85 right now. Going into the last week of the month, we are going to get way more data that will improve this number, but it's going to be around the 3.5 or so. That's the scoring the market on a 1 to 10. 10 the hottest, 0 ain't nothing going on. We're at the early part of that market. We're right around the 3 to 3.5 or so. That's where we are. Now, this is going to be a huge week for rates. There is a lot going on this week when it comes to rates. Let me go ahead and just get the rate sheet up here for you so that you can see exactly what's going on. Unfortunately, rates actually trended a little bit up last week. We were at 6.75, and then because of Thursday, Friday, it got up to 6.875. The other thing that happened is that FHA-VA went up. It went up from 6.375 now to 6.5. So that's what we're looking at for rates. Let me go ahead and share with you the bond market. The bond market is down a little bit. So we are down 1/10 of a basis point right now in the bond market. This is the day. It did go up. Let me go ahead and just do, if you look at the past week, it went up over the past week, went down a little bit today. So from 8:30 a.m. down till about, or 8:30 p.m. yesterday. Oh, this is Friday. This is Friday transitioning towards, there we go. That's today. Today it went down. There's that 2 a.m. This is the pre-market. And then as the market opened, went up, went back down, and now we are up. We're up 0.2 of a basis point on the 10-year Treasury bond market right now. We have crossed a repricing line last week. That's why we're at 6.875. Now, this week is going to be a huge week for rates. And it looks like the bond market is prepping for inflationary numbers and some not so good news when it comes to the economy. If we get better than expected news that will affect rates in a better way, we can expect a really dramatic correction. There's the Dallas Fed Manufacturing Index. They were expecting a 12.7 drop, came in on a plus 0.9. A lot of auctions going on today. Big one is going to be tomorrow, Wednesday, Thursday, Friday, a huge week when it comes to the economy. Tomorrow, we've got the Home Price Index, Case-Shiller Home Price Index. When this information is updated tomorrow morning, I will be able to update the following metrics. I will update the, right here, House Price Index, Freddie Mac House Price Index. I will also update the National Market Index. I'll update these two. These two will be updated tomorrow. We're also going to get the Pending Home Sales Index that is published by the National Association of Realtors. They are scheduled to release that tomorrow. So we're going to have the House Price Index pending, and we'll also update the National Index. I will send you an email when that information is updated so you can take a look at it, but it's going to be a huge day tomorrow at 8 a.m. We also have JOLT, job opening labor turnover. What's going on with the job market? We've got consumer confidence. A lot of information tomorrow. The big one is going to be on Wednesday, because on Wednesday, the favorite inflation indicator from the Fed is going to be published at 7:30 a.m., and that's called a PCE, Personal Consumption Expenditure. That's going to happen Wednesday morning. We've got mortgage data being published. And then going into Thursday, we've got a lot of employment figures. We've got personal income, personal spending. And then on Friday, we've got unemployment. This is the week where they're just cramming all of the economic data into a 5-day period, and it will have an effect on the bond market. It could be, we could see rates at 7 1/8. We could see rates at 6 1/4. It is that big of a deal this week. And it could go either way. There's no way that I'm going to predict what's going to happen with PCE figures or unemployment. Have no idea what's going to happen. We're just going to have to track this on a daily basis so that we can stay informed and we can keep our clients informed and educated on what's happening with the entire market. Any questions, you all? Any questions? Any questions, comments, concerns, criticisms, or complaints? Any questions? Let's see if we have any questions here. Any questions? No, we are like early. Well, no reason to stay if you don't have any questions. We need to make the best use of our time. So if we went over all the information and you don't have any questions, I want to remind you that we have our broker Q&A contract review and training on Wednesday. We are having a team meeting on Friday. If you do have any questions, please let me know. Feel free to reach out. Also, I want to remind everyone that Christy is out on vacation. She does come back Thursday evening, so hopefully she'll be at work on Friday. But Christy is out on vacation. But if you do have any questions or if you need anything, please reach out to my dad, to myself, and we are here to help you. If there are no questions, comments, concerns, criticisms, or complaints, thank you all so much for joining our Monday morning touch points. Super appreciate it. I hope you have an absolutely amazing day, and please feel free to reach out. Have a great day, and I will chat with you soon. Be on the lookout. I'm going to send you an email with a summary of this meeting, along with a few more resources. Have a great day, and I'll chat with you soon.